welcome to LawWiser on Air. I'm your host, Alokita Tangri, and today we're diving into one of the most closely watched policy developments in India, that is the Digital Competition Bill. This bill is being described as a game changer for how we regulate digital markets, with big implications for global tech giants, startups, and everyone in between. To help us unpack this, I'm joined by two distinguished guests, Dr. Mukul Shastry, Group General Counsel at Cube Highways, and Mr. Mustafa Bohra, Associate Partner at Solomon & Co. Thank you both for being here. So,
Thank
Mustafa,
you. The pleasure is mine.
sir, let me
Thanks for
start
having.
with you. The bill is being described as a major shift from the Competition Act 2002. What is it really trying to achieve, and how does it change the way we look at competition regulation in India?
So, under the present framework, action is taken only after the anti-competitive practice has already occurred. The Digital Competition Bill seeks to change this by introducing a preventive approach or a proactive approach, rather, to put it in a better word. Instead of waiting for a harm to materialize, it empowers regulators to impose upfront obligations on the large digital platforms that have a potential of distorting competition. This, to my mind, marks a shift from a reactive approach to an anticipatory approach, which ensures that the competition is protected before the damage is done.
Thank you so much. So, before we started this discussion, I was talking to Mukul sir, and there was a question that came to my mind. So, either of you can answer this. So, in your opinion, does India need a separate Digital Competition Act, or is the Competition Act 2002 enough with some modification for digital enterprises? Just a general question that I had. Mukul sir, do you have
Yeah.
anything to say
So
on that?
thanks, Alokita. Yes. We were discussing this that whether we need a separate act or not. So in a sense, it seems that yes, a separate legislation is required because digital markets are a different beast altogether, and maybe the ex-ante approach that you want to bring in under this digital competition bill, maybe in the current ex-post framework of competition act, maybe that fitting in that will be like something you're fitting by force, and that may result in some kind of means the interpretation may go haywire at times when it is scrutinized by a judicial mind. Therefore, it is better that you have an ex ante separate legislation because the approach is very, very different. And as the UK example also tells us that they have a separate legislation housed under the same authority. So maybe we can have a same model here, whereby under the same authority, under the same CCI, Competition Commission of India, we can have a digital market wing, and that wing can then handle the entire legislation, and they can definitely take advantage from the expertise of CCI, but then they can be specialist body handling the ex ante piece of legislation. So I feel that a separate legislation makes sense.
All right, all right. That answers the discussion. So, also, Mukul sir, some argue that the bill could stifle innovation or amount to premature regulation. How exactly might regulation discourage innovation among startups or smaller players? And can we point to examples either in India or globally?
No, it's a very interesting question, Alokita. And let's understand what this bill talks about. So let's just talk about two things. One is there's a definition of group, and it says the definition of group is same as of Competition Act. Competition Act says anyone who's invested into you, which with a percentage of more than 26%, is part of your group. So 26% is the threshold, in addition to the board seats and other things. So this means if a private equity fund invests 26% in a core digital enterprise. Now, what is a core digital enterprise? Means anything like WhatsApp or Facebook. So anything online search, online gaming, any other similar tool, web-based tools. IRCTC is like an example. So all these core digital service, if a foreign investor, private equity fund is invested into you, then you have to see the global turnover. Now, in that case, the global turnover of that entity which has invested into you may be in billions. So the threshold is either you have to have a turnover of 4,000 crore rupees in India, or your global turnover is $30 billion, or your gross merchandise value is 16,000 crore in India. So that is the first financial threshold. In addition to that, you have to have 1 crore end users or 10,000 business users. If you fulfill these twin criteria, then you are an SSDE, systemically significant digital enterprise. And if you are an SSDE, then a lot of compliance burden on you. Now, see a young company, a young fintech, which has just done a Series A, Series B kind of funding round. Now, they have a KKR, they have such kind of private equity players invested into them. Now, their global turnover is more than $30 billion because they have invested 26% into you, but you are still a small player. And 1 crore end users is not that great. We have 140 billion, 1.4 billion population. In that 1.4 billion population, 1 crore or 10 million is hardly anything. And mind you, it is end user. One person can have 2 mobile phones, can have two email accounts. So one person can be can translate to 2 or 3 end users. So the threshold is so less. So a fintech player, a smaller player, who has an investor of private equity fund, therefore the global turnover becomes bigger, and this person has 1 to end users, it becomes an SSDE. This means even your IRCTC, even your younger player like Just Dial and such similar platforms, they all become SSDE. And now they have to compete with a similar compliance burden as that of Google's and the Facebooks and others. So you see the kind of burden it may be there. Maybe it is an unintended burden, but still that burden is on them. Hence, I feel that there is a possibility that unless the regulators are so very clear in their approach, or when the rules things get clarified far better, there is a possibility that it may stifle innovation, especially in the fintech space, which is directly coming in the core digital business.
Right, very interesting. Thank you so much. Now, the bill lists 9 anti-competitive practices. Let's pick 2, say self-preferencing and bundling. Mustafa sir, do you think these are always harmful, or could there be situations where they may have legitimate business justifications?
See, to my mind, these practices are not inherently harmful. Their impact depends on context. Like, for example, self-preferencing, it can be harmful when a dominant platform uses placements or defaults or algorithm to unfairly push its own product and block the rivals. However, it can be legitimate if it improves efficiency or user experience. Same for bundling. Like, for example, if it can be harmful if it locks users into a ecosystem, and it raises switching cost or prevents competition in a sense. But it can be justified if the bundle lowers cost or improves quality for user. The key test is to see whether the conduct ultimately harms consumers welfare and the competition. That's the test that needs to be applied.
Thank you. Thank you so much for that. So, now coming back to you, Mukul sir, the EU has its Digital Markets Act, the UK has its own rules, and other countries are also experimenting. How does India's bill compare, and what lessons, both successes and pitfalls, can we learn from their experiences?
Oh, fantastic, Alokita. And many people say that our competition law is modeled maybe on the UK model or on the EU model. They say that we have just copied and pasted from there most of the things. But let's understand that what is the EU model and what is the UK model, and then what is our Indian model. Just let's understand the basics there. So when I talk about EU model, so there's this Digital Market Act. Now, what the EC or the European Commission, a kind of equivalent body to what we have CCI, what EC has done is they have identified certain gatekeepers. They have said that okay, these are the companies I want to focus on, like for example, Alphabet or Amazon or the Apple or the Googles of the world. And they said that okay, yes, or the Microsoft rather, Alphabet is Google. So so they said yes, these are the companies I would like to monitor, and they will have. And they are the core platform services, and they are having certain ex-ante obligations. So they have pinpointed specifically that, okay, this is what are the gatekeepers, and this is what I want to ensure that the compliances have to be done by them. So they have a very different approach altogether, where they have identified certain companies. UK model is very different. Their approach is very similar to what Indian approach is. They say that, okay, we have a code, we have a philosophy, and any firm which fulfills the threshold there Now that company will be given a strategic market status. Now this is someone which is going to impact the market strategically, and therefore I'm going to regulate them. So there's a principle, and whosoever comes in that principle is to be regulated. India, very similar to what is the UK model. We have very similar concept. We have an SSDE, systemically significant digital enterprise, which says that, okay, if you fulfill the twin criteria of the financial threshold, as I said, 4,000 crore Indian turnover, 16,000 crore rupees of gross merchandise value, or $30 billion of global turnover, if you have these three, and along with these three, any one of these three, and you have 1 crore end users or 10,000 business users, if you fulfill this twin condition, then you are an SSDE. And once you're an SSDE, you have all these ex-ante obligation on you, as you said, self-preferencing and all of this stuff. So you have to be ensuring that you do not have those things. And therefore, Indian model is very similar there. But then again, a single word of caution, which is there for India is concerned, especially. As I said, number one, there can be some unintended consequences because there can be some smaller players who may put in this bill of global turnover and 1 crore end users, and they may still not be that big a player to compete with the Alphabets and the Microsoft of the world. But in addition to that, the second thing that we have to be very mindful is that in India, there have been various judgments of regulators. For example, the Google Play billing case of NCLAT. Maybe that was the trigger of this competition law, maybe of the digital competition law. So what that case said was that Google Play or Google, what they were saying is that if you want to use my Play services, Google Play services, then all the billing that is happening, it has to be from my platform only. So this is what the self-preferencing is, that, okay, if you want to do the billing, you have to do the billing from my platform only, my services only. And NCLAT held that this is anti-competitive under the competition law, section 4. But whatever ex-ante penalties that they have imposed or the obligations that the CCI has imposed, they said no, ex-ante powers you do not have. And therefore, NCLAT said that ex-ante powers cannot be used until and unless the statute specifically provides you for that. And therefore, maybe the Indian regulators or the Indian government legislative, they thought that let's bring a proper legislation so that all these ex-ante harms, which are very much possible in a digital world, let's curb them. But there, the precedent that has been set by NCLAT is this, that for all ex-ante legislation, there has to be specifically mandated. And therefore, the reading or the law has to become more clear and more objective. Unlike the EU market or the UK market, where obviously in UK also the similar concept is there, but there ex-ante is given, that the threshold is not that high. In India, an ex-ante legislation has to be absolutely spot on, and the power has to be drawn from their statute itself, and very clear power has to be drawn. Otherwise, as NCLAT said in the Google Play billing case, that such powers cannot be granted just by inference. And that is where the word of caution we have to bring in. But as you said, EU law has a different approach. As I said, they have gatekeepers. UK has similar model. India is following a UK model with a certain twist. And given that Indian scenario or the Indian markets may evolve differently, and ours is a growing economy, faster economy, huge population, and a market which is attracting a lot of investors. So they're obviously keeping those things in mind. We have our legislation in place.
Thank you for explaining that so clearly. Now, we all know that regulation is only as strong as enforcement. So, Mustafa sir, could you tell us what challenges India faces in actually policing big global digital platforms? And do we need institutional reforms to make this work?
It's an interesting question. See, to my mind, there are three main challenges that India faces today. One is technical expertise. Digital oversight requires specialists such as data scientists, data engineers, etc. Now, that is something that is required in the first place. The second would be jurisdictional limits. Many of these large platforms are headquartered abroad, making cross-border enforcement will be difficult to my mind. The third would be slow litigation. I mean, we all are aware prolonged court battles can delay or undermine the effectiveness of the regulation. Now, there are some institutional reforms that can be implemented. For example, there can be a specialized regulator with technical capacity to direct investigatory powers. There can be faster procedures and limited emergency powers to handle time-sensitive cases. And the third and the last would be international cooperation mechanism to ensure that evidence collection and consistent enforcement across borders. I think these institutional reforms will definitely help in enforcement of these laws.
Thank you so much for breaking it down so clearly for ease of understanding. Now, Mukul sir, the bill uses criteria like turnover and user base to decide which companies it applies to. Do you think this one size fits all approach risks catching too many players or letting some slip through the cracks?
Very, very true, Lokita. And that is where the entire unintended consequence they come in. As I said, there's a possibility that some players who may not be that big, they become an SSDE. And likewise, there are some big players who may not be that they may not be that threatening, or they may not be someone who are harmful to the competition per se. They also get caught, and unnecessarily the compliance burden it goes up. So good for people like me who had legal compliance. Good for us actually. Higher compliances means our job is secured, but not good for economy, not good for the business per se. So I agree. We have this one size fit all. What we have done is we have simply said if your turnover is 4,000 crore and if you are having 1 crore end users, you are an SSDE, and now you have to be overburdened with this compliance. Interestingly, like even government platform, for example, IRCTC. Anybody who wants to book a railway ticket, they have to go and book it from IRCTC. It is the only kind of a platform, a complete monopoly, which is going on. Now, even that is a SSDE. So an IRCTC, which is a kind of a single kind of platform, although there are private competitions, you can book railway tickets otherwise also. But IRCTC is the most used platform for booking railway tickets. And now IRCTC, because it has a turnover of 4,000 crore and its end users are more than 1 crore, multiple crores. Therefore, IRCTC is an SSDE. Now, you understand this, that IRCTC has to also follow all those 9 principles that you are talking about. So they have to ensure, and they are in a constant ex-ante kind of a CCI's watch unnecessary, and the kind of compliance now they have to put in, because IRCTC, there is no complaint on competition angle for IRCTC. Till date, there is no CCI case also on IRCTC for competition or creating anti-competitive practices. But now with this legislation, they will be covered under this watch, and now they have to really comply with all those things. They have to maintain all those reports within 90 days. They have to give that report to CCI or to their wing, and the kind of compliance burden which has now gone up to them is unnecessary. So this means an additional cost and burden to IRCTC, and then that additional cost means more platform fee, more user fee ultimately that has to be borne by an individual poor person who's booking tickets to IRCTC. Well, that compliance cost, which now IRCTC has to bear, that will be passed on to its users. So those users are not like you and me who can afford that 1-2 rupee hike. They are poor people who are booking railway ticket. For them, even a 5 rupee hike makes some sense, or 10 rupee hike. I don't know what the numbers it will be, but even that 10 rupee, 15 rupee make a lot of the difference for them, for the major users. So that I'm saying, so this one size fit all, not understanding maybe the market, these can create such kind of unintended consequences. Maybe once we mature into, or maybe once this thing come to place, maybe they'll come with some kind of regulations. They will try to exclude some sector, or they will try to bring out something. But as of now, today, reading this bill on its own, I feel one is it can create problem to fintech or such startups. Number two, it can, and especially those who are on to go for private equity funding, because as I said, the group definition is very wide. Number two, it can bring these large players unnecessarily into the thresholds of competition compliance, which may otherwise will not make much sense. So there is a possibility of these two, and this has to then maybe more deliberated, and there has to be more industry kind of dialogue, so that the government can bring out with some kind of exemptions here. Like for M&A in competition, like they have brought a lot of exemptions they have brought in. That, okay, this is the threshold, this is that, something like that they can consider to bring for digital competition also.
Great, great. Thank you so much. Now, my last question is to you, Mustafa sir, which sort of adds on to what Mukul sir has already said when we talk about unintended consequences. So, like he also mentioned that the bill could end up hurting small businesses or startups, or, we could also say MSMEs, the very players that it's meant to protect. So, in your opinion, how could regulation be phased or tailored to avoid this?
See, to my mind, there is a genuine risk that compliance obligations will increase platform cost, which may then be passed on to small businesses. For example, implementing interoperability requirements would be costly, and platforms may shift that burden to smaller sellers or service providers. To avoid this, to my mind, the bill should be rolled out in phases. First, the larger platforms should be taken up first, while the smaller firms or the smaller platforms are given time and support to adapt. The object is to protect smaller businesses from being exploited and not burden them with regulatory complexities.
Thank you so much. And that brings us to the end of today's episode of LawWiser on Air. Thank you, both of you, for such insightful perspectives.